Hey, welcome. In this video, we are going to talk about a wonderful topic which has become so relevant in the current times. The topic is imported inflation. We'll talk about it in detail, but first, let's take a quick look at what inflation is. It is an increase in the general price level of goods and services in an economy. It can have many sources like demand pull shock, cost push shock, expectations, and of course imported inflation. Now coming to imported inflation. It is a general and sustainable price increase due to increase in the cost of imported products. Increase in the prices of these products like fuel, gold, materials and components increase domestic cost of production and lead to increase in the price of domestically produced goods. It may also be caused by a decline in the value of country's currency. The more the currency depreciates on the foreign exchange market, the higher the price of imports. Imported inflation may be set off by foreign price increases or by depreciation of a country's exchange rate. It's not a new concept in our society. We all remember the oil crisis of 1973 when the OPEC implemented an oil embargo leading to a shortage of oil in many countries. This led to a sharp increase in oil prices, which in turn led to higher prices for goods and services that rely on oil, such as transportation and heating. This inflationary pressure caused significant economic disruptions and recession in many countries. Another case of imported inflation is the Asian financial crisis of the late 1990s, where several Asian countries experienced a severe economic crisis due to a combination of factors, including currency devaluation, high levels of foreign debt, and declining exports. As a result, the value of their currencies declined sharply, leading to a higher prices for imported goods and contributing to inflation. Other cases are the global financial crisis of 2007 and 8, the 1971 US import surcharge, the 1980s Latin American debt crisis, the 1990s Russian financial crisis, the 2010 Venezuelan economic crisis. There are many examples.
Imported inflation can have a number of negative outcomes. For example, reduced purchasing power, reduced competitiveness on a global scale, reduced standards of living, social and economic inequalities, and so many more. It can have macroeconomic impacts like leading to an increase in the trade deficit. If the central bank of a country decides to counteract the effects of inflation by increasing interest rates, it can lead to a decrease in economic growth and investment. But what's interesting to see is that imported inflation has some positive outcomes too. For example, the government may collect more revenue through taxes and duties on these products, which can help to fund public services and infrastructure projects. It can also increase demand for domestic goods, which can stimulate local industries, create jobs, and support economic growth overall. A similar thing was noticed in 2020 when the COVID crisis created inflation around the globe. India launched its Self-Reliant India Atmanirbhar Bharat Abhiyan mission to promote Indian goods in the global supply chain markets and help the country achieve self-reliance. They allocated funds worth rupees 20 lakh crore, that is US dollar 268.74 billion, amounting to about 10% of India's GDP, as a stimulus package to incentivize domestic production. Overall, we can say that outcomes of imported inflation depend on a range of factors, including the strength of the local economy, government policies, and global economic conditions.
Now let's look at the measures which can be taken to mitigate the impact of imported inflation. These include measures such as imposing tariffs or quotas on imports, devaluing their currencies, increasing efficiency and productivity, or increasing domestic production of goods and services. One of the most common ways to manage imported inflation is through monetary policy, specifically through adjusting interest rates to discourage borrowing and spending, which can help to slow down inflation. Another way could be through trade policies, where governments can negotiate trade agreements to ensure that imports are subject to fair pricing and avoid sudden price spikes. This concept of imported inflation has become so relevant in the current context, especially because of ongoing conflict between Ukraine and Russia. In 2019, Russia and Ukraine exported 26% of world's wheat, but since the war, there has been disruption in those supplies. Russia is one of the world's largest producers and exporters of natural gas. The Ukraine is a major transit country for Russian gas exports to Europe. The war has therefore led to shortages and higher prices for natural gas in Europe and other parts of the world. This war has led to significant devaluation of the Russian ruble and Ukrainian hryvnia, which has also brought instability in the financial markets. It should also be noted that the conflict has led to political uncertainty, which has affected the confidence of investors and businesses and has led to a decrease in foreign investment and a reduction in economic growth, leading to higher prices for goods and services. And with these remarks, we conclude our video. Thank you for listening.